Hi and welcome to the Economic Update for July 2018. With me is Will Hickson, our investment specialist at Morgans Financial, to help talk through the last few months of 2018 financial year and the year that was. So Will, the last few months of the financial year looked reasonably strong for share markets.
Yes, Justin. So both in Australia and for most international share markets, we saw a relatively strong quarter to finish off the financial year. So here in Australia, the market was primarily driven by a huge continuing recovery in resources and energy stocks, which have just been continuing that recovery after some very tough years in 2014 and 2015. So look, that's something we've mentioned in many of the past economic updates, and some of our preferred exposures like BHP and Oil Search were really strong over the quarter. So look, on the opposite side, while they're still paying good dividend yields, it was a tough quarter for the banks with the Royal Commission, and also tougher for Telstra.
Well, that sounds like the last few months might have been indicative of what we saw for the full year. It was a reasonable year for share markets offshore, but a real struggle here for Australia outside of the resources and the energy sectors.
Yeah, absolutely, Justin. That's fair to say. The market really was two speeds here in Australia. So the resources and energy sectors were just powering along, but many other sectors sort of puttering along or even having negative years. So as I look through client portfolios, it's generally a case that resources, energy and global exposures are the real positive contributors to growth. Other Australian shares, together with property and fixed interest exposures, were relatively flat or even slightly negative on a yearly or sort of on an annual basis. However, these contributed very well by way of dividends, usually between sort of 5 and 7%.
Yeah, sure. I mean, Will, on the topic of dividends, Will Douglas has done a piece on the importance of these, which I'll be sending through to clients shortly. Many of our clients have portfolios whereby dividends are a vital part of the investment strategy. And one of the main reasons for this is that we see dividends as a far more reliable source of annual returns versus capital growth. And when the share market gets volatile, companies' dividends are not impacted and can in fact act as a safety net in times such as these. And isn't that right, Will?
Yeah, that's right, Justin. So Will Douglas goes into more detail on this in that video, but some rough numbers for you. So over the last 3 financial years in total, the share market has delivered something like an 8% return by way of capital growth over those 3 years. Whereas, well, actually a lot of that's been resources and energy, whereas it's delivered 17% over the same period by way of dividends. So that's 70% of the total return. So don't underestimate dividends.
Absolutely. And Will, dividends aside, as I look through portfolios, it seems like the international exposures have been the major positive contributors to the growth in portfolios.
Yeah, that's right, Justin. So many of our preferred exposures in that space had really strong positive years, which was great. But the standout was really a company called PM Capital, which is a listed investment company which owns a portfolio of diversified, growing international businesses. So top holdings are things like Alphabet, which is Google's parent company, Pfizer, the big healthcare giant, as well as Bank of America. So the capital of that share, the share price was up 20% over the past year, plus it paid about 4 or 5% in dividends. So, you know, a really good year and something I thought we'd point out.
Yeah. And Will, perhaps a quick summary of the long-term economic update the long-form economic update from Will Douglas in the year ahead.
Yeah, so Justin, there's a lot in there. Will talks about the US-China trade war, continuing US interest rate rises, the Banking Royal Commission, North Korea and the sort of the situation there, very different to what it was. And he also talks about the rising infrastructure spend in Australia and how we want to get clients positioned for that. So look, you know, we've used this chart quite a few times now, but we think it's still very relevant. This just shows that we think we're still in the recovery stage of share markets, and we're cautiously optimistic going forward. So we're continuing to monitor some of the key risks to markets, but look, for the time being, we're still broadly comfortable.
Great, thanks, Will. And as always, if you have any questions, please don't hesitate to contact us and call through. We look forward to speaking to you soon. And until then, all the very best from Will and I.